What's going on, guys? Welcome back to the channel. So I just went through the president's budget and I pulled out 10 points that I wanted to go through, explain. This is a first look, so I haven't gone over every little detail here, but let's go ahead and go through these together, see what we got. So this is all on the whitehouse.gov's website, and the headline, the president's budget cuts the deficit by nearly $3 trillion over 10 years. And of course, there are going to be people who will debate that. But in any case, let's get on with number one, and that is the carried interest loophole. Now, if you don't know what this is, the carried interest loophole allows fund managers to basically take the income they're getting from the fund, and rather than paying an ordinary income tax rate, and they make a lot of money, so that would be at 37% for ordinary income as the top rate, it's actually only at 20%. Now, this is something that's been debated for a long time, but that's something that they want to close the loophole on. So that's number one. Number two has to do with your IRAs or Roth IRAs, the mega backdoor strategies. And you can see right here, the headline or the bullet is ending loopholes that let billionaires exploit middle-class retirement savings incentives. So we heard a lot over the last couple of years of billionaires basically having these massive Roth IRAs. But what's interesting, you see I highlighted it right there. The budget limits the amount taxpayers with incomes over $400,000 can hold in tax-favored retirement accounts. Now that's interesting too. Even hold in tax-favored retirement accounts, not even contributions. So that's kind of interesting. The fact that I don't even know exactly what they're going to do or what limits they're going to say you can only have this amount if you earn that amount. And $400,000, what if someone earns over 400 and then falls back? I have no idea, but that is what is right in front of you. It seems kind of crazy to me. Number three on the list is going to be dealing with crypto. This isn't as good as, I don't think it's as good as people think it is. And this is eliminating the tax subsidies. There's no subsidies for cryptocurrency transactions. So basically, you can sell a crypto at a loss and take a substantial tax loss to reduce your tax burden, and then buy back that same crypto. And saying you can't really do this with stocks and bonds. That's not entirely true, kind of the way it works. But realistically, I don't see this really as much of a loophole. You have a loss on a crypto. It doesn't matter what it is, whatever you think of crypto. You have a loss on a crypto, you sell it, you realize the loss, and then you buy it back. The whole goal is to make money. So if you're going to end up making money, that crypto has to appreciate over time. Yeah, sure, if you don't sell it, then you're not going to pay the gains in that particular year. So you can do stuff to move your taxable situation. But that means when you buy it back at a lower price, then you're going to have more gains later on down the road. So that's why I say it's not quite as good as I think that bullet wants you to believe it is. The next one is looking at the corporate tax rates going from 21% to 35%. So the budget would set the corporate tax rate at, not at that 35%. It would bring it to 28%. Currently, it's at 21%. Still well below the 35% rate that prevailed prior to the 2017 tax law, Tax Cuts and Jobs Act, I believe is referring to. So that's going to be not a great one either, because a lot of people are looking at this thinking, hey, this is good because corporate profits are making all of this money. What's inside of your retirement plan? What's inside of your 401k, your 403b, whatever retirement plan that you have? Stocks. So I don't know. Stocks and bonds, if they're not doing as well, that's going to hurt your retirement. I don't think that's a great provision. Number 5 is the child tax credits. So currently, right now, it's at $2,000, and they want to bring it up to $3,000, and it's similar to what we had previously. So it's $3,000 per child for children 6 years old and above, and $3,600 per child under the age of 6. And I believe that's very similar to the advanced child tax credit. It's not exactly the same. My math is correct. Then that $3,000 to $3,600. But what it's not doing is it's not adding an additional component to it. So previously with the advanced child tax credit, it was the 150, if my memory serves me right, $150,000, and then there was the $400,000 limit for married filing jointly for the additional 2,000. So there's kind of like two thresholds. This looks like it's just going to say, you know what, we're going to get rid of the 2,000, just make it 3,000 or 3,600. So that is what the bump would be. So, and I'm going to assume that it's going to be at $200,000 and $400,000 because I haven't seen anything different from that. And it will make it fully refundable. In addition to that, the earned income tax credit would be available without kids. That's number 6. 7 was the stock buybacks. So that one is kind of interesting and also falls in the category of I don't think it's a great idea. And it goes back to the corporations saying, listen, or not the corporations saying, the politicians saying these corporations are making too much money, so we need to kind of tax them more. So in this instance, what they're going to do is they're going to tax share buybacks at 4%. Currently, it's at 1%, and they want to bring it to 4%. That also doesn't make a whole lot of sense because if you have a company and you have cash in the bank, you're going to make the decision to reinvest it back in the company, but maybe there's not a great opportunity. So you look at your stock price and you buy back those shares, and that increases the value of the remaining shares. That's how that works. And that is also what's inside of your retirement plans. So I just think that you should know that because I don't think that's a great provision. And the next one, let's see. This one is going to a top tax rate of 39.6% for single filers making more than $400,000 or married filing jointly at $450,000. So yeah, that's not a whole lot more, but every percent counts. Here's what taxes would be. And I always think that this actually gets lost in translation because we look at the rate and the net amount people are paying. I mean, look how much you have to pay in taxes if you're single earning $400,000. You have to pay $107,047. So that they always talk about pay your fair share. Well, fair share could be anything that they want to call fair. Fair is subjective. So $450,000 for married filing jointly, that would equal $92,800 today. Those are both today's numbers. Those are just wanted to show you what those taxes are in actual numbers. No credits or other deductions except the standard deduction was applied here. Okay. The next one is for real estate, and this is the like-kind exchanges loophole, which is, I believe they're referring to the 1031 exchange. So what this means is that if you have a rental property and you decide you're going to sell it, but you immediately go and buy another property and you take that money and you roll it into that new property, well, then you're not going to realize your gains for taxes. You can roll it into that next property at 1031 exchange. And I don't even know when that was created, but that's been going on for as long as I can remember. They want to close it. They don't want to have that. There are a lot of negative consequences to doing something like that because it's not all large corporations that own properties. You can have a family that just has 1 or 2 rentals. I own a rental. So it's not like I have 4,000 rentals. It's like we're doing this every single day. And I think that makes it kind of difficult because then it's like, well, then I won't sell the property. Then what happens? Well, then you're not getting turnover in the market saying, hey, I don't want to realize these capital gains, so we're going to hold on to this property forever. And I think that would actually be a negative consequence where the 1031 says, hey, you can unload this property and get this other one and we won't tax you in order to do it. That gets things moving. So I don't know. That is what I think. The last one is the premium tax credit is going to be permanent. And that was actually going to, I believe, get eliminated in 2025 or 2026. But now, or with this proposal, and this is all a proposal, that's all this is. Premium tax credits, expanded premium tax credits from the Inflation Reduction Act extended. So by making it permanent, that's what it's saying right there. So I do talk about the premium tax credit. And if you're kind of wondering how that works, that's through the healthcare.gov marketplace. You have to get your health coverage through that in order to get the premium tax credit. And if you can't get your income below it, then you can qualify for those premium tax credits. So those are the 10. I just wanted to go over those really quickly. Yeah, so I don't know. Let me know what your comments down at the bottom. Go over to our Discord channel and I'll put up some more content over there. And as I go through this a little bit more, I will do more videos. But hopefully this has helped. I just wanted to go through what I think are some of the more important parts to this, the President Biden's budget proposal. So if you've enjoyed this video, be sure to subscribe and we'll see you on the next one.